Back. We are continuing in Chapter 12, talking about payroll taxes now. We've done 12-1 application problem. We filled out the time card to find out how much you earned, but what you earned is not necessarily what you take home. There are things coming out of your paycheck, and the answer to that is taxes. Well, what kind of taxes are there? There's income taxes, and there are also taxes that go to other areas of the government. When we talk income taxes, Minnesota has a state income tax. We also have federal income tax. That will come out of your paycheck before you get it. There will also be FICA tax or Social Security and Medicare taxes that get taken out of your paycheck. You may, depending on how advanced we want to look at this, you may have other things that are taken out of your paycheck before your paycheck is taxed. Things like 401k contributions, 403b contributions, retirement savings. You could have things like flex medical, flex daycare. That's a little bit beyond the scope of what we're doing here, but those are some other things that could come out of your paycheck to go from where you earned your money to what you actually take home. When we look at our payroll taxes, our federal and state are going to be numbers that you have some say in how much is taken out of your paycheck. The other two, your Social Security and Medicare, you do not have any say. That is just automatically taken out at a specific tax rate. Well, how do you have a choice or a say? Well, when you first go start working for someone, you're going to show up and you're going to have some paperwork to fill out. One of those documents you're going to fill out is something called a W-4 form. Okay, and this is an older version. Our textbook's probably 10 years old or so, but the general idea is the same. When you fill out your W-4 form, you have your employee name and address. You're going to have your Social Security number so they can prove that you are actually you. And when they take the taxes out, send it off to the government, they send it off and credit the right person. Next up, you are going to have your marital status. Are you married or single? And that will determine a certain tax table they will use. And you also will have your withholding allowance. Now, in general, the lower your withholding allowance, the larger amount of taxes taken out of your paycheck, the higher your withholding allowance, the smaller amount of tax that is taken out of your paycheck. Okay? When it's all said and done, you will get to the end of your year. For us, it's January or December 31st. And your employer will then send you a document that says, hey, Ricky Selby, you have earned X amount of dollars, and we have taken out X amount of dollars out of your paycheck. We've taken it out in federal and state income tax. We've taken it out in Social Security and Medicare. We have sent that chunk of tax to the government. That form you're going to get is called a W-2. Now, you're going to get a W-2 for every single job that you have. And when you fill out your tax return or your 1040 form, 1040 tax return, you will then compare those numbers. Your W-2 form says, how much did I have withheld? Federal, state, social, Medicare. My 1040 tax return says, what was my fair share? How much should I have paid the government? I did pay the government on the W-2 side. How much should I have paid the government on the 1040 side? If you paid in more than you needed to, the W-2 is bigger than the 1040, you'll get a refund. If you did not pay enough, meaning the W-2 amount withheld is not enough compared to the 1040 tax return, you will then owe the government or the IRS some money. Okay, so that's what all of this is used for. You tell your employer how much should be taken out on the W-4 form in federal and state income tax. You then have a certain set percentage taken out in Social and Medicare. You get to the end of the year, usually around late January, February, you're going to get your W-2 from your employer. Add all your W-2s. By April 15th, you're going to fill out your 1040 tax return, send that tax return on to the government, and it'll be how much should you have paid, pay enough or not quite enough. When we look at the actual math side of things, okay, here is what the tax table will be. Now, we're going to do a brief one here. When and if you become a payroll accountant, we'll get into much deeper, but we're just talking generic numbers. This is a married person table, right? Now, there would be a single person table, a different one from this, and your textbook are going to have those tables on page 347 and page 348. 348 is the married person one, so if you jump forward to 348, you'll see something that looks like this, kind of your pink table here. It's a married person table, and it's a semi-monthly pay period. Now, your wages, how much did you earn, right, from your time card? Along your very left-hand side here, and again, we don't have a lot of all the numbers here. If my earnings was $1,040 to $1,060, depending on what I filled out on my W-4, if I said zero allowances, your employer would have $78 taken out of your paycheck in federal income tax. They'd have another table they'd look up for state income tax. We won't do that here in accounting too, but understand it's the same process as federal income tax. However, if I chose, and again, I voluntarily told my employer how much should be taken out. Let's say I had my withholding allowances at 2, not a 0. Well, in that same amount of earnings, I would have $46 taken out and set aside for federal income tax. I go all the way over here to the right, and at this earnings level, $1,040 to $1,060, if I chose 6 allowances, I wouldn't have any federal income tax taken out of my paycheck. Now, that doesn't have much, if anything, to do with how much I should have paid the government. It is how much am I going to send to them every pay period. The IRS and the federal government is going to want some amount of money to operate on a weekly or a biweekly or a monthly basis. They don't want to wait until the very end of the year to get their tax dollars. Take a look at this example. What if I told you, I will hire you today, January 1, you come work for me? You say, sweet. I tell you, I'll pay you $60,000 a year. You're like, game on. Awesome. I'll write you one check for $60,000 on December 31st. You may go, that doesn't sound like a great idea. You want me to work 364 days and then get one big chunk at the end of the year? You probably wouldn't take that. Well, why would the federal government want that as well? They're going to need cash flow during the year. So employers are going to take these taxes out of the paycheck every 2 weeks, twice a month, weekly, potentially, depending on what type of payment you're getting. They will hold on to it in an account called federal income tax payable or state income tax payable or social security tax payable, blah, 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 blah. Payable, meaning it's a liability, credit balance account on the right side of the accounting equation because we owe the government a certain amount of money. We take it out of your paycheck, hold on to it, and eventually send it to the government. So one, you got to make sure you find the right table. Are you using a married person table because your employee said they were married, or are you going to use the single table? You'll go ahead and locate that employee's total earnings. You then scroll over to the right and see which withholding allowance did they select, and that tells you how much they want taken out of their paycheck in federal income tax.